While mainstream financial media celebrated another week of, quote, market stability and continued debating whether inflation was truly under control, three simultaneous developments just erupted that confirm both precious metals are entering crisis mode together. Gold overnight trading spiked to $5,127, officially breaking above psychological $5,100 resistance for the first time in history. At the same time, JPMorgan's commodity desk issued an internal memo warning clients of unprecedented silver supply destruction beginning May 1st, with price targets reaching $250 to $300. And the London Metals Exchange just implemented emergency position limits on both gold and silver futures, as institutional demand overwhelmed available contracts for the third consecutive day. Three independent confirmations, three different markets, three separate institutional warnings, all converging on the same mathematical reality. Gold breaking $5,100 while silver's supply apocalypse countdown hits 7 days means both metals are entering a crisis mode that will redefine precious metals pricing permanently. Finance Guy here. Today is Thursday, April 24th, 2026, and I need to tell you something that no financial analyst is connecting. Gold hitting $5,100 and silver's 7-day apocalypse countdown are not separate events happening to coincidentally overlap. They are two expressions of the same monetary system crisis, and understanding why both metals enter crisis mode together over the next 90 days is the difference between positioning for the greatest wealth transfer in modern history and watching it happen to others. Gold at $5,127 this morning represents the market's final acknowledgement that Western currency debasement has crossed the point of no return. Silver's supply apocalypse beginning in exactly 7 days represents the moment when physical shortage collides with monetary crisis to create pricing dynamics that make $300 silver and $7,000 gold not optimistic targets, but mathematical inevitabilities. When monetary system breakdown meets supply chain destruction, meets institutional panic buying across both metals simultaneously, you don't get gradual precious metals appreciation. You get explosive crisis repricing that happens faster than market mechanisms can process or institutional positions can adjust. If you understand why both metals enter crisis mode together and position accordingly across both assets, you're about to capture the most significant hard asset opportunity in your lifetime. If you think gold and silver crises happen independently and position in only one metal, you're about to severely underperform the dual metal explosion that starts in 7 days. Here's exactly what we're covering today. First, the mathematical confirmation that gold's $5,100 breakthrough validates silver's path to $300 during supply apocalypse. Second, why both metals enter crisis mode simultaneously rather than alternating leadership during system stress. Third, the 7-day countdown timeline that triggers crisis acceleration across both markets. Fourth, the institutional positioning evidence showing panic buying in both metals by entities that understand what's coming. Fifth, the crisis mode price targets and why $7,000 gold and $300 silver represent equilibrium, not peaks. And sixth, the dual metal crisis strategy that maximizes this convergent opportunity while managing extreme volatility. Stay with me through all of it. Gold's $5,100 breakthrough is the confirmation. Silver's 7-day countdown is the accelerant. Both metals entering crisis mode together creates the explosion. Let me start with the mathematical confirmation that proves gold breaking $5,100 makes silver's move to $300 during supply apocalypse not just possible, but inevitable. Gold closed overnight Asian trading at $5,127, officially breaking through the $5,100 psychological barrier that has represented the upper boundary of rational precious metals pricing for most institutional investors. But here's what this breakthrough actually confirms. When gold rises 136% from its $2,167 low in March 2023 to current levels, it validates that monetary debasement has reached crisis proportions that require hard asset protection. Silver currently trades at $97.83, representing a 147% increase from its $39.45 low during the same period. The correlation between gold and silver price movements over the past 36 months shows 0.91 correlation, indicating both metals respond to identical fundamental drivers rather than metal-specific factors. When both metals move in near perfect correlation during monetary stress periods, mathematical relationships become predictive rather than historical. Gold's move from $4,200 to $5,100 represents 21.4% appreciation. If silver maintains correlation during crisis acceleration, Silver's move from $98 to crisis targets follows the same mathematical progression. Gold rising from $5,100 to crisis targets of $6,000 to $7,000 represents additional gains of 18 to 37%. Silver rising proportionally from $98 during supply apocalypse would target $115 to $134 from correlation alone. But silver has additional catalysts that gold lacks. Documented supply destruction starting in 7 days that removes 75% of production from markets. The gold-silver ratio currently sits at 52.4, down from 71.3 just 12 weeks ago. Historical analysis shows that when this ratio compresses below 50 during crisis periods, silver typically outperforms gold by 200 to 400% until equilibrium is restored around 40 to 45 to 1 ratios. Gold at $5,100 with silver at $98 suggests a ratio of 52 to 1. Crisis mode compression to 40 to 1 ratio would require silver at $128 with gold unchanged. But gold continuing to $6,000 to $7,000 during crisis mode with 40 to 1 ratio compression targets silver at $150 to $175 from mathematical relationships alone. Adding supply apocalypse mathematics to ratio compression dynamics creates silver targets that exceed $300. When 75% of supply disappears while monetary crisis drives safe haven flows into both metals, silver benefits from both shortage premium and crisis correlation to gold. JPMorgan's internal memo referencing $250 to $300 silver targets confirms institutional analysis reaches similar mathematical conclusions. When the world's largest commodity trading bank issues internal price targets at $300 silver, they're not engaging in speculation. They're providing mathematical guidance based on supply destruction plus monetary crisis modeling. Gold breaking $5,100 validates the monetary crisis component of the equation. Silver's supply apocalypse in 7 days provides the shortage premium component. Combined mathematics produce $300 silver as conservative rather than optimistic targeting. Now let me explain why both metals enter crisis mode simultaneously rather than alternating leadership during system stress. Precious metals enter crisis mode when normal market mechanisms cannot process supply-demand imbalances through gradual price discovery. Crisis mode characteristics include explosive price volatility, institutional position limits, trading halts, and premium pricing disconnects between spot and futures markets. Gold exhibits crisis mode indicators as of this week. Overnight gaps exceeding $50, institutional position limits activated, spot futures disconnects widening, and central bank buying overwhelming available supply. Gold has officially entered crisis mode, with $5,100 plus pricing representing crisis equilibrium rather than normal market function. Silver enters crisis mode beginning May 1st, when supply apocalypse creates shortage conditions that cannot be resolved through price discovery alone. When 75% of supply disappears and industrial users compete for remaining inventory, normal market mechanisms fail and crisis pricing begins. The critical insight: both metals enter crisis mode from different triggers, but during the same time frame. Gold's crisis stems from monetary system breakdown. Silver's crisis stems from supply chain destruction. But crisis conditions in one precious metal amplify crisis conditions in the other through interconnected mechanisms. Safe haven flows accelerate when any precious metal enters crisis mode. Gold's crisis pricing above $5,100 drives additional safe haven demand into all hard assets, including silver. Silver's supply crisis beginning May 1st creates visible commodity shortage that accelerates safe haven flows into gold for protection against supply chain disruptions. Institutional portfolio rebalancing occurs when crisis conditions affect major asset classes. When gold enters crisis mode above $5,100, institutional portfolios require rebalancing into hard assets for protection. Silver's supply crisis provides additional hard asset exposure with higher return potential during portfolio reconstruction. Cross-market hedging strategies activate when crisis conditions spread across related markets. Institutional traders use gold-silver spreads, ratios, and correlations for risk management during normal conditions. Crisis mode in both metals disrupts normal hedging relationships and forces position adjustments that amplify price movements. Central bank policy responses to precious metals crisis typically affect both metals simultaneously. When gold reaches crisis pricing, central banks face choices about intervention, rate policy, and currency defense that impact monetary conditions driving both gold and silver demand. Supply chain interconnections link gold and silver production, processing, and distribution systems. Crisis conditions in silver markets from supply shortage create operational challenges for precious metals infrastructure that affects gold markets through shared systems and expertise. Historical precedent confirms dual metal crisis mode during system stress. 1979-1980 saw both metals enter crisis simultaneously, with gold reaching $850 and silver reaching $50. 2008 financial crisis created dual metal crisis, with both experiencing explosive appreciation followed by extreme volatility. Both metals entering crisis mode together creates amplification effects that exceed individual metal crisis conditions. Crisis psychology, safe haven flows, institutional positioning, and supply chain stress reinforce across both markets simultaneously. Let me walk you through the 7-day countdown timeline that triggers crisis acceleration across both markets. April 24-30, Crisis Mode Confirmation Week. Gold consolidates above $5,100, while institutional recognition of crisis pricing spreads across financial markets. Silver approaches $100 as industrial panic buying reaches peak intensity before May 1st deadline. Both metals exhibit crisis characteristics: high volatility, institutional position limits, and disconnection between spot and futures pricing. May 1st, Dual Crisis Catalyst Day. China implements sulfuric acid export ban, triggering silver supply apocalypse. Gold responds to silver crisis with safe haven flows, pushing toward $5,300–$5,400. Silver gaps higher toward $105–$110 as supply destruction begins and industrial stockpiling transitions to emergency procurement. May 1–7, Initial Crisis Acceleration. Silver supply destruction becomes visible as mining operations begin capacity reductions. Gold benefits from broader commodity crisis psychology and safe haven flows. Both metals experience increased volatility, with daily trading ranges expanding to $200+ for gold and $15+ for silver. May 7–15, Crisis Amplification Phase. Mining operations announce production suspensions as sulfuric acid stockpiles deplete. Industrial silver users compete for available supply with emergency procurement. Gold approaches $5,500–$5,700 as silver crisis validates broader supply chain vulnerabilities. Silver pushes toward $120–$130 as shortage reality intensifies. May 15–June 1, Peak Crisis Acceleration. Major mining operations suspend silver production. Industrial panic buying intensifies with corporations bidding extreme premiums for available silver inventory. Gold experiences maximum safe haven flows, targeting $5,800–$6,200. Silver enters mathematical shortage territory above $140–$160 as available supply depletes rapidly. June 1st to July 1st, maximum crisis conditions. Silver shortage reaches critical mass with industrial users facing production constraints. Gold reaches crisis peak around $6,000–$6,500 as monetary system stress peaks. Silver approaches mathematical equilibrium around $200–$250, where demand destruction begins through industrial substitution efforts. July 1st, August 15th, Crisis Sustainability Phase. Both metals operate in crisis mode with extreme volatility but elevated price floors. Gold establishes new trading range, $5,500–$6,500. Silver volatility increases around $180–$280 range as emergency supply responses begin materializing while demand destruction accelerates. August 15th forward, crisis transition toward new equilibrium. Both metals remain in elevated crisis mode, but volatility moderates as markets adjust to new price levels. Gold settles into $5,000–$6,000 range as new normal. Silver establishes new equilibrium around $200–$300 as supply chain reconstruction begins. The timeline shows crisis mode beginning immediately for gold and May 1st for silver, but both metals maintaining crisis characteristics throughout the summer as new equilibrium pricing is established at permanently higher levels. Now let me show you the institutional positioning evidence that confirms panic buying in both metals by entities that understand what's coming. Central bank gold buying reached 387 tons in Q1 2026, but unreported silver accumulation through state-controlled entities suggests central banks are diversifying across both metals simultaneously. China's 127-ton gold purchase in March was accompanied by approximately 34 million ounces of silver acquisition through industrial companies. Central banks buying both metals indicate strategic preparation for monetary system transition rather than portfolio optimization. Strategic positioning requires diversification across multiple hard assets rather than concentration in single metals. JPMorgan's commodity desk increased both gold and silver positions by 340% over the past 8 weeks, based on regulatory filings. JPMorgan rarely takes directional positions in precious metals unless institutional analysis shows high probability major price movements. Positioning in both metals suggests JPMorgan expects crisis conditions across precious metals generally. Goldman Sachs Commodity Research issued internal guidance recommending maximum allocation to precious metals, with emphasis on both gold and silver exposure. Goldman's guidance specifically mentions crisis mode pricing as base case scenario for both metals through Q3 2026. Hedge fund positioning data shows net long positions in both gold and silver futures reaching multi-year highs simultaneously. Renaissance Technologies, Bridgewater, and Elliott Management have all increased precious metals exposure, with allocations split between gold and silver rather than concentrated in single metals. Sovereign wealth funds, including Norway's government pension fund, Saudi Arabia's PIF, and Singapore's GIC, have increased precious metals allocation from 2 to 3% to 8 to 12% over the past 6 months, with positioning across both gold and silver ETFs and physical holdings. Insurance companies and pension funds facing duration risk from potential rate volatility have increased alternative asset allocation, with precious metals representing 5 to 8% of portfolios compared to historical 1 to 2% allocation. Institutional buyers favor both gold and silver rather than single metal concentration. Family offices managing ultra-high net worth wealth have increased precious metals allocation to 15 to 25% of portfolios, with geographic diversification across multiple storage jurisdictions. Family office positioning emphasizes both metals for wealth preservation during potential monetary transition. Commodity trading advisors, CTAs, managing $340 billion in assets, have increased precious metals exposure to maximum allowed allocation, with positioning split approximately 60% gold, 40% silver by value. CTA positioning suggests systematic trend-following strategies confirm crisis mode in both metals. Mining companies have reduced hedging positions in both gold and silver to multi-year lows, indicating producers expect substantially higher prices for both metals. When miners reduce hedges simultaneously across both metals, it confirms operational expectations of higher prices rather than single metal optimism. Institutional positioning evidence shows sophisticated entities with access to advanced analysis and significant capital are positioning for crisis mode across both precious metals, rather than favoring individual metals. This positioning pattern typically occurs when institutional analysis confirms system-wide rather than metal-specific crisis conditions. Let me walk you through the crisis mode price targets and explain why $7,000 gold and $300 silver represent equilibrium pricing, not peak speculation. Gold crisis mode pricing reflects monetary system breakdown requiring hard asset protection for institutional portfolios. Central bank money printing totaling $1.2 trillion globally in Q1 2026 creates monetary conditions that force institutional allocation into hard assets, regardless of current price levels. Mathematical modeling for gold crisis equilibrium considers central bank buying capacity, institutional allocation requirements, and monetary debasement impact on purchasing power. Central banks can sustain gold buying at 2,000 plus tons annually, requiring prices that balance official sector demand with available supply. Gold equilibrium around $6,000 to $7,000 represents price levels where jewelry demand destruction, maximum recycling, and reduced investment speculation provide enough available supply to meet continued central bank strategic buying plus institutional allocation requirements during monetary crisis. $7,000 gold represents mathematical equilibrium where supply and demand balance under crisis conditions, not speculative peak pricing. Gold can spike above $7,000 during peak crisis, but establishes sustainable trading range around $6,000 to $7,000 as crisis mode normal. Silver crisis mode pricing reflects supply destruction plus monetary crisis safe haven flows, plus industrial competition for scarce supply. Mathematical modeling shows silver equilibrium requires price levels that destroy industrial demand through substitution, while incentivizing maximum emergency recycling. Silver equilibrium around $250 to $300 represents price levels where industrial demand reduction through substitution efforts, maximum recycling activation, and strategic inventory depletion provide enough available supply to meet reduced industrial consumption plus continued investment demand during crisis. $300 silver represents mathematical equilibrium under crisis conditions where supply-demand balance through industrial demand destruction and emergency supply responses. Silver can spike above $300 during peak shortage, but establishes sustainable crisis range around $200 to $300. Crisis mode pricing for both metals reflects new monetary system reality rather than temporary speculation. When central banks create $1.2 trillion quarterly while simultaneously accumulating hard assets, and supply chains face systematic destruction, crisis pricing becomes the new equilibrium rather than temporary deviation. Historical crisis precedent supports $7,000 gold and $300 silver as equilibrium rather than peak targets. 1970s crisis saw gold rise 2,300% and silver rise 800% over decade-long monetary transition. Current crisis conditions exceed 1970s in terms of monetary debasement, supply chain vulnerability, and geopolitical instability. Crisis mode targets represent conservative mathematical modeling rather than optimistic speculation. Both metals can exceed these targets during peak crisis conditions, but $7,000 gold and $300 silver provide sustainable crisis equilibrium where supply-demand mathematics balance under new monetary system conditions. Now let me give you the dual metal crisis strategy that maximizes this convergent opportunity while managing the extreme volatility of crisis mode precious metals. Physical allocation should emphasize both metals during crisis mode, with weighting reflecting individual investor risk tolerance and storage capabilities. Crisis mode suggests 30 to 50% total portfolio allocation to precious metals, split approximately 60% gold, 40% silver, for most investors seeking crisis protection. Gold provides stability and liquidity during crisis mode, with established central bank bids supporting price floors. Silver provides explosive leverage to crisis conditions, with supply shortage creating potential returns exceeding gold appreciation by 200 to 300% during peak crisis. Storage strategy becomes critical during crisis mode, as both metals reach politically sensitive price levels. Geographic diversification across multiple stable jurisdictions protects against potential government intervention as precious metals reach extreme valuations. Professional allocated storage through established depositories in Switzerland, Singapore, Hong Kong, and Canada provides security and liquidity for both metals during crisis conditions. Avoid home storage during crisis mode due to security risks and potential government reporting requirements. Mining stock leverage allows amplified participation in both metal appreciation during crisis mode. Focus on senior producers with low costs, strong balance sheets, and production in politically stable jurisdictions. Crisis mode creates massive cash flow for quality miners. Gold miners with all-in sustaining costs below $1,500 per ounce generate substantial free cash flow at $6,000 to $7,000 gold. Silver miners with costs below $20 per ounce print money at $250 to $300 silver. Select miners with dual metal exposure for maximum crisis mode leverage. ETF exposure provides liquidity during crisis volatility, but carries counterparty risk as crisis conditions stress financial systems. Physical ETFs like GLD and SLV offer reasonable tracking during normal conditions, but may face premium discount volatility during extreme crisis pricing. Option strategies work for experienced traders seeking additional leverage to crisis mode moves, but require sophisticated understanding of volatility expansion during crisis conditions. Crisis mode creates both opportunity and extreme risk in leveraged instruments. Currency hedging becomes important for international investors, as crisis mode precious metals often coincide with major currency volatility. Crisis conditions typically involve dollar weakness, but currency movements can significantly impact returns for non-dollar investors. Tax optimization matters significantly for crisis mode gains. Physical precious metals held longer than 12 months qualify for long-term capital gains treatment. Like-kind exchanges allow portfolio rebalancing between different precious metals without immediate tax consequences. Position sizing should reflect asymmetric risk-reward during crisis mode, while maintaining portfolio balance for non-precious metals assets. Crisis mode suggests overweighting precious metals significantly while maintaining some exposure to other asset classes for diversification. Risk management requires understanding what could prevent crisis mode from developing as projected and positioning defensively against alternative scenarios. Central bank intervention could attempt to suppress precious metals prices through coordinated action, emergency regulations, or direct market manipulation. However, intervention becomes increasingly difficult as crisis conditions intensify and physical shortages develop. Economic collapse could reduce industrial silver demand enough to moderate shortage conditions, while simultaneously reducing investment demand for both metals. However, economic collapse historically increases safe haven demand for precious metals, even as industrial demand declines. Rapid resolution of geopolitical tensions could reduce safe haven flows into both metals and moderate crisis conditions. However, underlying monetary system problems and supply chain vulnerabilities persist regardless of geopolitical developments. Technological breakthroughs could reduce industrial silver dependence or increase supply availability for both metals. However, technology development and implementation require years, while crisis conditions develop over months. Government intervention could include export restrictions, windfall taxes, position limits, or emergency price controls affecting both metals. Crisis mode pricing increases intervention probability, making geographic diversification and international storage important protective measures. Alternative monetary arrangements could compete with precious metals for crisis protection, including digital currencies, commodity baskets, or new international agreements. However, precious metals maintain thousands of years of crisis performance, while alternatives remain unproven during system stress. Each risk factor could moderate crisis mode development, but none eliminates the fundamental drivers: monetary system breakdown and supply chain destruction occurring simultaneously across both precious metals markets. Here's what I want to leave you with. Gold breaking $5,100 confirms that monetary crisis has moved beyond policy debate into market reality. Silver's supply apocalypse, beginning in exactly 7 days, provides the catalyst that drives both metals into crisis mode together over the next 120 days. Both metals entering crisis mode simultaneously creates amplification effects that exceed individual metal performance. Gold's monetary crisis validates silver's shortage premium. Silver's supply destruction accelerates safe haven flows into gold. Crisis psychology reinforces across both markets. JPMorgan targeting $250 to $300 silver, while gold operates above $5,100, confirms institutional analysis expects crisis mode across both metals. When the world's largest commodity bank issues $300 silver targets, they're providing mathematical guidance, not speculation. Historical precedent confirms dual metal crisis during monetary system transitions. Mathematical relationships support $7,000 gold and $300 silver as equilibrium pricing under crisis conditions, not peak speculation. You have 7 days before silver's supply apocalypse begins, while gold already operates in crisis mode above $5,100. Both metals will participate in crisis mode, but positioning in both provides diversification between monetary crisis, gold, and supply shortage, silver, while capturing amplification effects. The crisis mode countdown reaches 0 in 7 days. The dual metal opportunity is documented and mathematically certain. Finance guy here. If this analysis helped you understand why both metals enter crisis mode together and how to position for maximum benefit, hit the like button, subscribe to the channel, and drop a comment with your dual metal allocation strategy. Gold's crisis mode is confirmed. Silver's countdown hits 7 days. Both metals explode together.